Hello, and welcome to today's session, PPP, the final word. Before we start, let's review a few items to help you participate during this event. Here's a sample attendee interface or control panel. You should see something like this on your own computer in the upper left corner. You may submit text questions by typing into the chat pane of your control panel. Questions may be sent at any time. We will collect these and address them at the end of today's session. When submitting your questions, please indicate if you would like the question directed to a specific panelist or to all. A recording of the presentation will be available in the on-demand portal of the convention within 48 hours. Handouts are available for download in the Handouts pane of your control panel. You may download these at any time during the presentation. Now I would like to introduce David Wiggins, Principal at CliftonLarsonAllen.
Hi, thank you, Brittany. Thanks everybody for attending. We look forward to talking with you this afternoon. I think we're talking about a subject that is kind of a lot of people have gotten exhausted on. It started back in basically March last year and continued through today. And I think a lot of people are getting a little weary of hearing about it, but it was a boon for dealers as it gave them funding to operate throughout this crisis. And I think for that, we're all, when it occurred, I think everybody was very very appreciative. And it will help get a lot of people through this. I've been doing this. I'm a partner in our dealership group along with Lee Ferguson, who's joining me.
How's it going, Dave?
Good. We've been doing this I've been doing this for over 25 years. Our group really just specializes in working with dealerships, buy-here, pay-here dealerships and finance companies. So we appreciate the opportunity. And with that, we'll jump into it. With that, I want to just mention this is our normal disclaimer that basically, with regard to any specifics in this program, you should be checking with your own tax advisor for detail. This information is current through basically September 29th. And so if anything's happened since then, we may or may not address it. Today, we're going to be talking about basically the Ppp Flexibility Act, which is basically an add-on to the PPP program that is kind of governing the rules we're working within today. So we'll address those and what those changes were. We find a number of people have kind of, lost. There's been so many dribs and drabs of information that I find a lot of people have kind of lost exactly kind of what the rules are. Hopefully today, Lee and I will kind of go through that and kind of give you sort of an idea what the playing field is right now and sort of what's going to affect people. We will talk briefly about some Karazhak Tax Provisions. These are just ones that relate to automobile dealers. There's a number of different act provisions that could have certain, applicability to certain people, but we'll address the ones that really seem to affect automobile dealers. We'll be talking about the economic injury disaster loans, which is referred to as the EIDL program, and some information there that a lot of people may not know. And then we'll touch on the executive order that President Trump issued regarding FICA taxes. There's been a little bit of confusion there. And lastly, we'll talk about kind of what looks like some of the future assistance and how it may affect your dealership. Lastly, you'll notice that we were hoping by the time, we got to doing this with the convention that this would be the final word and we would have all the answers. As you'll see, unfortunately, we still don't. And so there still could be, some pieces there that we'll have to update for everyone. The Ppp Flexibility Act. This was signed in law on June 5th. And basically the main things it did is it changed the normal PPP program that had been an 8-week covered period program to a 24-week period program. And unfortunately, this didn't come out till about the end of everybody's 8-week covered period. So a number of people did some things that if you look back, they may not have, as far as bringing on people that they really didn't need for payroll, paying some people some extra wages and that kind of thing, only to find out that had they, waited, that we would have had 24 weeks to do this, and it may have changed some people's planning. With that, I would say we're going to kind of address the 24-week period and kind of walk through some of the key things and where it really, kind of plays out for everyone. It set a minimum term for anybody that has loans that don't get forgiven of 5 years, which was initially 2 years under the program. It extended the deferral period until forgiveness is remitted to the lender to 10 months. So basically it gave you 10 months from the end of the covered period, again, which could be 8 or 24 weeks or somewhere in between, before you have to submit for forgiveness. It changed. There was a 75-25% requirement. The 75% of your forgiveness had to be for payroll, and no more than 25% could be for other items, which we'll talk about. The Flexibility Act changed this to a 60-40 test. So it basically says that payroll now only has to be 60%, and that your non-payroll items that are covered can't exceed 40%. So this is a lot looser. And basically, I find this whole Flexibility Act, it really helped a lot of people qualify for forgiveness and made the process easier. The last thing that was real significant in this act was it did allow for employers to defer paying employer share of FICA. So on any employees that a dealership or finance company has, they're required to pay an employer share of FICA equal to what the employee pays. And that's a 6.2% amount that's paid. And essentially, when that first came out, it said if you get a PPP loan, you can't qualify for this deferral. The Flexibility Act said, yes, we're going to allow employers to not pay that 6.2% of FICA for their share. So they're trying to help cash flow for people. One thing to be aware of there is if you did that, this doesn't mean you get out of it. So anybody that's not paying that now, you could have kind of a cash flow benefit, but realize you'll pay all that back 50% in 2 installments, one due December 31st, 2021, and one due December 31st, 2022. So those were the key items that sort of changed, and then we'll kind of jump into some of the more specific areas. First, if we look at payroll cost, there are some limitations that are placed on how much payroll can be covered under these 2 periods. And basically, you have the option to use an 8-week covered period or a 24-week covered period. And a lot of people said, look, I want to use the 8-week period. I think I will get full forgiveness. I don't want to mess with this thing for 24 weeks. So they proceeded that way. So you'll have to look at that. And there are some people that may have qualified. There is a change later we'll talk about with regard to the rent expense that can be used. And some people that thought they would qualify for an 8-week period may no longer find out that they qualify for full forgiveness, and they'll want to use the 24-week period. Basically, compensation per employee can't exceed $100,000 annualized for a year. So this means if you're using an 8-week period, you have $15,385 of compensation for any one employee that can count. Beyond that, you're not allowed to count it. If you're using a 24-week period, this increases the amount so that any employee can make up to $46,154 for the 24-week period before you'd have to disallow part of their forgiveness. So it's just kind of a number side on that, and it's just relative based on the week you're using for your covered period. We will talk that also it's likely you can use a period between 8 weeks and 24 weeks. The statutes provide for that. We have not got information on that. So it's likely if somebody hits total payroll that exceeds their PPP amount in like week 16, they can probably cut off their covered period as of that point if they meet all the other requirements. Unfortunately, as we'll talk later, none of the applications to submit to lenders actually provide for this situation, and there's still some unanswered questions. So we think you can do it, we just don't have the guidance out on how you exactly do that. There is a limitation for owners on this, and I just mentioned this, like I said, especially in the 8-week period. We had a number of owners that said, hey, you know what I'm going to do is take my payroll up to $100,000 annualized, and I'll get more, even if I didn't take that in prior years. Basically, the SBA saw this and said, hey, we're going to limit owners. We're not just going to let them get full forgiveness by increasing their payroll. We're going to limit them based on what they took the prior year. So even though $100,000 a year applies for most of your employees, for owners, it's actually could be 100,000 or less. So if you have an owner in 2019 that took $50,000 of compensation, he's not going to be able to take $15,385 for an 8-week period. He'll have to reduce it in half. So that's just realize there are limits on owners, and that only certain compensation counts per person. Okay, what are the limits for health and retirement? And basically, payroll, health, and retirement are basically the components that factor into the payroll piece. So this is the 60% piece we're talking about. With employees, it's basically considered a non-cash benefit, and therefore it's not subject to the $100,000 limit. So if you have an employee that gets the amounts we just talked about that caps out the 100,000, they can include health and retirement in addition to that. Even though they're over the 100,000 cap or the portion of it, they can include health and retirement benefits above that. And this only applies to the employer contributions. So if you have, health insurance and a company pays half of it, the only part that you can count for forgiveness is just the half the employer actually pays and doesn't get reimbursed for. Health and retirement costs for self-employed people are not allowed. So if you're paying yourself, if you're self-employed on Schedule C and you have health or retirement costs, you cannot include those in your forgiveness. And then basically with owner employed, you're going to see that basically they cap it at, for 8 weeks, they cap it at 8/52 of what's paid for the year, which makes sense. For the 24-week period, again, they're capping at 2.5 months worth. So again, they're kind of looking at owners a lot like the tax law does a lot of times, and saying that, we're not going to let you increase or get a benefit on some of these items. We're going to kind of cap owners to these limits. And basically for health insurance, they're saying that's excluded for owner employees because it's already should be included in their compensation. Now, we have some people that they don't actually count for that period. They don't count the health insurance as part of that. So therefore, you could count the health insurance if it's not included in compensation. Okay, we talked the payroll costs are at 60%, and non-payroll costs are going to be limited to 40%. Those non-payroll costs, we've probably all seen this before. We have interest on mortgage obligations, we've got rent, we've got utilities, and we've got interest on other debt obligations, okay? All these must have contracts placed in service as of February 15th of 2020, okay? If you look, these are fairly clear. We will talk about some unknown items that apply to these areas as we go. Okay, the first one, and this came out fairly recently in the last month, relates to related party rent. We had talked forever about the fact that as part of the 40% that we thought that if you had related party rent, you got to deduct the entire rent payment. There was nothing basically that said otherwise. And so a lot of people relied on this. This is what we believed was going to be issued also. Then lo and behold, we're surprised that they came out with a limit on related party rent. And essentially it says that you have to have a lease agreement in place on February 15th. No problem there. But it basically said if you have common ownership between the borrower and the entity the rent is paid to, and you look to some IRS code sections on that to determine if they're related. But most of us, if we have related party rent, we sort of know what that is. But what they did is they said that if you have rent, you're only allowed to deduct rent to the extent it equals the mortgage interest paid by that related company. So if you look at our example here, we've got basically somebody paying a $10,000 a month to a related party LLC. And you've got it, and that LLC has a $500,000 mortgage at 5% interest. So effectively, in 1 month, there's $2,083 a month of interest expense paid. The amount eligible for forgiveness is $2,083. The remaining $7,917 of our $10,000 a month rent payment cannot be used. So as you can see, for a lot of people that thought they were going to get deduct the $10,000 as forgiveness, now you find out in this case you only have $2,000. For somebody that has a related party, and let's say there's no mortgage on it and they're just paying rent to it, there's no deduction there. As we'll see later, that with the 24-week period, this likely isn't a huge deal and will still relate in most people getting forgiveness. But what is a big deal is that for a lot of people that thought they were going to get forgiveness based on the 8-week period, they included all the rent they paid to their related entity. Well, now we find out that a lot of that rent may not qualify, and that therefore may keep us from getting full forgiveness on an 8-week period. And all of a sudden we have to look at a 24-week period. I know I had a number of clients that we had that situation, and it that's going to change how we thought we were applying on an 8-week period, and now we find out we're going to have to go to a 24-week period or some period in between. There are still a number of items with regard to dealerships and PPP that are unknown, and I've kind of listed some of those. Most of these fall in that 40% other item, and that has to do with floor plan assistance. If you look, most dealerships have floor plan and they're paying interest on that. We still don't know if that counts as eligible for forgiveness. It seems logically like it should. We think, floor plan is tied directly to inventory and should count, but there's no guidance. I know, NIADA, NADA, and a number of other associations have requested guidance for this, from the IRS or from, the SBA, and we have not gotten anything at this point and don't know that we will. There are some places in the guidance we've gotten on PPP that they indicate gas expense may be another item you could count. And again, at this point, we don't know. I mean, dealerships have a lot of gas expense that they fill up. Can they count that? We just don't know. Salesman compensation. There's a lot of question, and a lot of people even paid some salesmen more comp than they would have otherwise paid because of the 8-week covered period. We think in general, based on some language in there, that if you have a salesperson that their pay plan has not been changed, even if they're making less because they're selling less units, that they should not result in you having to, reduce, come up with a salary reduction, which we'll talk a little bit later. Interest on loans securing company assets, including inventory. If you have general loans that cover it, can you deduct that? No guidance. Shareholder loans. If we've got loans that shareholders put money in, they're paying interest. Can we deduct that? That one probably we don't think so, but again, no guidance. Cell phone bills and trash collection. Both of those we do think should fall on the utility side and be counted, but again, we don't have specific guidance.
So I want to talk about the loan forgiveness reductions. Now there are there's going to be three considerations that you need to look at in order to that could potentially reduce your PPP loan forgiveness amount. So the first item here is all your eligible expenses, and this includes your rent, your payroll, your interest expense, eligible interest expense, reduced by your FTE quotient and your wage reduction calculation. And that FTE quotient is going to be based on your head count during the covered period as compared to 2 prior look back periods, which we'll get into. And the wage reduction is going to be based on how much you reduced an employee's wages during the covered period as compared to the first quarter of 2020. The second factor is going to be limited to the amount of your PPP loan. Now, if you've got expenses over the amount of the PPP loan, it's probably not going to be an issue, but it is one of the limiting factors in this calculation. And the third and last one is going to be your payroll cost used during the covered period. And your payroll cost, that's going to be just your regular payroll. That's going to be the retirement plan expense, the state unemployment tax expense, and the health insurance costs. Those are your payroll costs, and it's going to be those costs during the covered period divided by 60%.
If I could jump in, Lee, and just point out on that last slide, basically, that's really a key thing for people to understand, is since you have basically take the minimum of any of these three, you can see that the first one, you take all your eligible expenses. And because we have up to a 24-week covered period, I think a lot of people will find that by the time you take their payroll for 24 weeks, their other expenses for 24 weeks, they're way over the amount of their PPP loan.
Right.
Well, if you take and subtract from that the FTE and salary reductions, a lot of times you'll get a number that it greatly exceeds the amount of their PPP loan. And the effect of that is essentially the FTE reduction and wage reduction really won't have any detrimental effect on a borrower, and they'll still get full forgiveness. And I just think that's key, because everybody had a lot of attention on FTEs and wage reduction.
Sure.
And I think now, we can realize that, that shouldn't have driven the boat, and that if we do have it, it probably won't hurt a lot of people. So
right. It's certainly something that, you may have more of those expenses, and it may not be as harmful as we had initially thought. So how are we going to measure FTEs? I just want to get into this real quick. Like I said, the importance of this could have been reduced somewhat by the extended 24-week period, but you do need to calculate this information in any case. So there are two ways to calculate your FTE, or what equals an FTE. So an employee who works 40 hours or more per week is considered one FTE. If they work under 40 hours, they could be considered half of an FTE, unless you use the standard calculation, which is basically you use, any employee 40 and over is capped at one FTE. If they work under 40 hours, it's then going to be basically a ratio of what a percentage of amount they worked compared to the 40 hours. So you could have an employee with a 0.7 FTE calculation, or an employee with a 0.3 FTE calculation. And it's best when you go through your application, it would be best to maybe use both of those methods just to see where you're going to come out. There's also going to be FTE exceptions for unfilled positions. So if you offer to rehire or are unable to hire similarly qualified employees, those will not count against you. As well as if you've offered to restore hours to an employee and they've rejected it. I've heard of some clients who their employees have not wanted to be hired back because they're still, they're either taking care of somebody with some immune system issues, and they just don't feel comfortable going back to work. This would cover that. If you fired an employee for cause, that will not count against you. If they voluntarily resign during the covered period, that's not going to count against you. And if you voluntarily requested and received reduction in hours during the covered period, those employees will not count against you either. So just keep that in mind when you're putting together the application. There are some exceptions if you feel that FTE count is limiting you in any way.
Hey, Lee, with regard to that, I assume that, what's your thoughts on, how should somebody document that? Some of that, I assume people should be aware of that.
Yeah, oh, absolutely. I think you need to, dig into the detail of the payroll reports. Now, there are some payroll providers that will kind of create these reports. But what I've seen from some of those payroll provided reports, they're not always completely accurate. These, it can be a complicated calculation if you're not sure what you're looking for. So you should certainly.
I think I was talking about if they were fired for cause or, whatever, that they probably, I assume that documentation is the key to kind of be able to evidence that.
Oh, absolutely. Yeah. You would want to make sure you document if any of those exceptions that I mentioned, you would want to make sure you have some type of documentation. I mean, if they're fired for cause, I mean, you would probably have some sort of report or some sort of documentation to, basically just show why they were fired. If you have any issues with the state unemployment, I mean, I'm sure there's something you could provide if need be to document those employees. So getting into this FTE test, and this kind of just highlights this FTE quotient that I discussed earlier. So in this example here, the FTEs during the covered period were 10. There was 10 employees, basically 10 full-time employee equivalents. And during the benchmark, they had 15 FTE employees. So the benchmark period, there's two benchmark periods. There's one from 2/15 to 6/30/2019. And then you have another benchmark period from January 1 through 2/29/2020. So you're the lower of those two time periods for your FTE count are going to be your benchmark period that you use to calculate this FTE quotient. So in this example here, there's going to be a reduction to the total cost, the total eligible expenses by a factor of 33% because of this FTE reduction, because they reduced their employees by 33%. But again, there's another exception here. It says qualifies for the safe harbor based on FTEs at the earlier of application date of 12/31. So if they get that FTE calculation back up to 15 before 12/31, or before they file the application, the earlier of those two, they will not get dinged for this on the FTE count.
But at least, again, I just wanted to mention, so this is the first part of those three tests. So if you have overall expenses, they're pretty high. Even if you had a reduction of, say, 33%, you may still get full forgiveness, right?
That's right. That's right. Yeah, exactly. I mean, if you've got, a $1 million loan, and you've got, and you've got $1.5 million of eligible expenses, I mean, obviously, I mean, that could potentially, you would still have enough to get the full forgiveness still. So just how do these safe harbors work, because I did mention them. So there's a couple other safe harbors. If you're unable to operate at the same level of business compared to prior to February 15th, and if the reduction stems directly from the compliance with COVID requirements from the CDC or OSHA, you will not be required to do this FTE calculation. They're basically giving you a pass and saying, hey, you don't need to be, you're not subject to the same requirements that somebody who is able to operate without these additional requirements has. So the second safe harbor is if the borrower reduced their FTEs from February 15th through April 26th, and the FTEs are restored by the earlier of December 31st or the application date, again, there's going to be no FTE reduction. So these two scenarios, you would not have an FTE reduction.
So safe harbor just basically means a way that you qualify to not have to penalize yourself for an FTE, right?
That's correct. That's correct. Yeah. The other part of this, so when I mentioned that first test, it was the FTE it was the total expenses reduced by the FTE calculation and this wage reduction test. So with this, and this is the wage reduction test I'm going to get into here. So the wage reduction test basically measures the average salary or hourly rate during the covered period or alternative covered period compared to that employee's first quarter wages, okay? It only applies to employees during the covered period. who made less than $100,000 in 2019. So any employee who made less than $100,000 on any one paycheck is not subject to this. So the I mean, as far as this $100,000 test goes, if you've made on a prorated basis more than $100,000 in any one pay period, you're not going to be subject to this. So if somebody got a $5,000 weekly paycheck, they're not going to get hit with this. They wouldn't even come into the discussion for this calculation.
So that's a paycheck for 2019 though, right?
That's correct. That's correct. 2019. There's going to be no penalty for the reduction in hours. So if like you said, if you have somebody who is working, an hourly employee who's working less hours but has the same pay rate, they are not going to get hit with this payroll reduction because they still have that same pay plan. They still have that same hourly rate. That has not changed. That's what they're looking at to determine if there's a wage reduction or not. And there's also a safe harbor with this wage reduction as well. If you reduced your employees between 215 and 426, but reinstated that wage back up to what it is during the covered period, prior to 12/31, you're not going to get dinged for this. So as long as you increase their wages back up to what it was to the pre-February 15th level, you're not going to get dinged. So the forgiveness reduction, if any, applies to the full 24 or 8-week period, regardless if the employee was there for the entire period. So if you got an employee who is only there for a partial period of time, this still could apply to them as well. So if you got an employee who left during this covered period, they're still going to get dinged for not getting paid for the remaining time in that covered period. So this is something you want to watch out for. But this only applies if you're going to be changing an employee's hourly rate, wage, or salary.
Congress, when they passed this law, provided that any income, that there would be no income when this PPP money was received or the loans were forgiven. The problem, what happened then, was when the IRS looked at what the law was, they said, okay, that's right, there's no income on the PPP loans, but tax law provides that if you have expenses paid with income that's not taxable, that those expenses aren't deductible. So Congress issued basically notice that said, when you have expenses for this PPP loans that were covered, you can't deduct those expenses. Well, the effect of that is basically to say that PPP loan amounts are taxable. As soon as the IRS came out with this notice, immediately Congress, you heard a number of congressmen, and probably about 7 or 8 congressmen immediately said, no, our intention was to give them a tax benefit equal to the PPP amount and allow them to deduct those expenses. Unfortunately, because we're dealing with law, even though they're saying that, until the law is changed, basically that is the rules we're playing with, is that basically those expenses paid for with the PPP amounts are non-deductible, which effectively says you take the PPP amount and the amount is taxable. So right now, that is what it is. We are still watching, and we feel like this may change in future laws, but as of now, it is not. And so people have to plan for that. As we're going forward, we've got to basically, as we talked about, apply for forgiveness once our covered period's up. And I think most people will find their covered period under the 24-week cycle is coming up. It either happened in the last week or two, or it will happen in the next couple of weeks. Right now, there's 2 forms provided for by the SBA, the Form 3508EZ and the Form 3508. And basically, this is kind of, for a tax guy like me, this is basically an easy form and a full long form like we have with our personal taxes. The EZ form is the way that everybody would prefer to apply if they're eligible. It gets rid of a lot of the details from the long form. It's basically, it's only for certain eligible people though. and that's self-employed people that have no employees. It could be, it also applies to people that meet safe harbors or calculations in which they would have no wage reductions or no FTE reductions. So if you don't have any wage or FTE reductions, somebody can also use the EZ form. If not, they're required to use Form 3508, which requires reporting by employee to show wage reductions and FTE headcounts and a number of similar things. And it's pretty difficult. We do expect probably the Form 3508 to eventually provide for some period. Right now, the two forms provide for either a covered period of 8 or 24 weeks. As we mentioned, the law indicates like you can probably pick an interim period of like 16 or 18 weeks, but right now the applications don't really facilitate that. So if somebody wants to use a different period, they probably cannot actually file for forgiveness at this point. One other thing to consider is there is a lot of discussion in the banking community and a number of different lobbying associations. If somebody has a PPP loan less than $150,000, we think it's likely there will be a certification application in which basically a borrower signs 5 or 6 certifications saying he met this use of funds and this use for employees and payroll. And they basically sign that and they'll be virtually done and guaranteed. It'd make the process very simple. There's a little discussion of making that possibly up to $2 million of PPP. I don't really see that one happening, but there is some discussion along that line. That brings us up to the next question, which is when should we apply for PPP forgiveness? And a lot of people have said, oh, it's 8 weeks. I want to get this over with. I'm going to go ahead and apply. In general, this program, if you look at the whole way through it, procrastination is good. You know, basically you want to delay applying for forgiveness. You want to delay applying for a loan, which is too late at this point. You want to use the longest period of coverage you can. And so if you have full forgiveness in 8 weeks, then use 8 weeks. A lot of people, especially like we talked about with that rent adjustment, will not qualify in 8 weeks. Then basically you should look at going with 24 weeks. Even if people weren't monitoring that period and they have some FTE or salary reductions, it's likely they'll still get full forgiveness for some of the factors we talked about previously. To some extent, you see, we say relax. Basically, the later you file, the better off you may be. Because there are a couple of things come into play. And one of which is sort of from a tax perspective, and that is that, as we said, the PPP amount is taxed, and therefore, if somebody doesn't have, and we've looked at this, if somebody doesn't get forgiveness from the SBA, but before year end, we think there's a position, and probably it's how things should work, to claim all the expenses in 2020 before we had forgiveness, and then pick income up the following year. Well, this essentially gives most people 1 year before they have to pay, the tax on it. And a lot of people know that if I can delay paying tax for a year, I'd rather go that way. So it may be beneficial to file late for one thing. Secondly, there's also the fact, like we talked, that Congress has indicated that they really intended this to be non-taxable. And, with regard to that, if you wait to file, and, the longer you wait and the later you file, the more likely it is that Congress may have time to enact law that allows that we don't have to pick up this amount as income. So again, like I said, delaying your forgiveness application may prove to be beneficial. If somebody gets an amount forgiven in 2020, files all their tax returns, and then gets the law changed, they may have to go back and amend tax returns or kind of deal with the effect at that point. Okay, basically when to apply for PPP forgiveness. We talked about most people's covered period has or will run shortly. And once that runs, basically you'll have used all the proceeds for forgiveness. And then you essentially have a couple of things. Is the Flexibility Act provided 10 months from the end of the covered period. So if somebody's covered period ended September 30th, they'll have 10 months or basically until July 31st before they've got to even apply for forgiveness. This gives a lot more time for us to get guidance, to get good information together, and to do, you know, all the forms accurately with the best information available. After you submit it, it goes to the lender, and the lender has, by law at this point, 60 days to review the application from the borrower and either approve it or ask for more information from the borrower. So there's 60 days there, and then the SBA, once the lender has submitted to SBA, has 90 days to review the application and forgive the loan. So if you look, all told, that means that once a covered period ends, there could be 15 months before we know when forgiveness is. And so there could be that long before you've got, you know, until you've got that, you know, forgiven. And like I said, there could be some tax benefits in basically waiting for that. Okay, I guess with regard to this, and we'll jump into some other things, PPP forgiveness, kind of our final thoughts are that, you know, like I said, this keeps changing week by week. We want to probably file later rather than sooner so that we get good information, so that we know what works, and so that we do the process correctly. It could result in different tax and financial statement answers. And for that reason, you'll want to look at the tax effect on this, on your situation. We talked about that if you don't get forgiveness till next year, you probably don't pick up income till next year. Some people, for certain reasons, could want to pick it up in this year. And even although we have no information on this, we do think there's a position to take that you could pick up the income in 2020, even if you don't have forgiveness, if you'd prefer to, assuming you're an accrual basis taxpayer. So you've probably got some option on when you want to pick it up and what's most beneficial. The other thing you probably want to look at on this is bank covenants. There's other bank loan covenants and lender terms that you should look at, because you're going to have basically a loan on your books at December 31st for this PPP amount. If you look at some loan agreements, you can't have other debt that you take without the bank's approval. So you could have a covenant violation if you have a bank that kind of wants to come up with some issue to cause you trouble or, you know, do something with your loan. So do look at your bank covenants and talk to your lenders ahead of time to make sure where you're going and how this will play out for you at year end. We're going to hit a couple of Karazhak Tax Act provisions. We're going to basically just cover those that apply to dealerships and their owners. First one is there is an employee retention credit. This is a 50% credit for up to $10,000 of wages for an employee. This does require two things: that you cannot have applied for PPP loan that we just talked about. And it also requires that you have some of your business was closed partially or fully for a period of time. I just mentioned this. This has kind of been passed over. There could be places somebody should look at this, especially if they did not get a PPP loan. So anybody that didn't get a PPP loan should be looking at this. You know, for people here, that could apply to some of us with regard to our related finance companies, depending on if we were required to close and things of that nature. Secondly, under the Tax Cuts and Jobs Act tax law that passed about a year and a half ago, losses for single and married people were limited to $250,000 or $500,000 for businesses. So if you had a married couple that had $1 million in losses from various businesses, it was limited to $500,000. Well, the CARES Act basically did away with this limit and said you can go back and amend those returns or take it into account for your 2020 return, and you can take more than the $500,000 loss. So this maybe allow you in the current year to offset investment income or wages or things like that. It also comes into play that you may be able to generate a larger loss for the past or current year that you can carry back, because the third item on our list is the net operating loss carryback change. Again, the Tax Cut and Jobs Act bill got rid of any carryback for losses from business. Well, in the CARES Act, they went back and changed this and said that for 2018 through 2020, losses that a taxpayer has, you can carry those back to up to 5 years. So for let's say somebody had losses of $600,000 that they could get due to changing their excess business losses, they can carry that back to 2013 when they may have had significant income. And the other thing is that prior to 2018, a lot of people were in higher tax rates. So they may be able to carry losses back from 18 or 19 to 2013, 14, or 15 years that had higher tax rates. And I find this has been out there, but a lot of people have kind of overlooked this one. And I would suggest you look at your situation and see if there is any opportunity to do some planning with these 3 items. I want to jump now into the EIDL loans. These came out with the CARES Act. A lot of people are familiar with these. Number of people did not get these. Some people did apply for these. It was one of those, a lot of people applied. The website to apply got jammed up. You didn't hear anything. But as time went, they started funding a lot of these for people. And a lot of people looked at it very simply and said, hey, wow, this is a loan that's got a 30-year term that has an interest rate of 3.75%. It's collateralized by my business assets, but it's not got any personal guarantees. It's like, wow, this is a windfall. I want to jump on that, and they applied for as much as they could get. And I think a lot of people then got this, and like many other governmental programs, they sent the paperwork over, and I think a lot of people took advantage of it, but didn't really read the fine print. And I just want to point out some things to watch out for. There's a lot of kind of gotchas in this that I think people should be aware of, and they need to read the terms closely. I think some people may even want to, if they got these, to look at repaying it as quickly as possible so that none of these other terms, come in play. And, realize that this is a governmental program, and that, basically the SBA or other governmental entities may be under a different congressional regime, could go back and look at this. It's public information, and they could question it. And a lot of times in SBA program, we found where if somebody has tax refunds and has not paid their SBA loans, that they'll take tax refunds. So, again, look at these closely. And if you've got these, go back and reassess your current situation. There are a number of terms. And like I said, we've seen a lot of companies get between 100,000 and 500,000 of these loans. Here's some of the terms in there that I'll just run through. Is basically, this loan has a security interest in all business property. This may keep other lenders from lending to you in the future, because there's an SBA lien placed on all your property. The requirements that if you sell a fixed asset or a franchise, you may have to notify the SBA before you're able to do that. Well, a lot of people sell fixed assets, and they're not going to plan on notifying the SBA. You could be in default on your loan terms. It basically says that you won't incur any future borrowings without consulting the SBA. Well, if you've got floor plan or other inventory lines, this means you may not be able to increase those from the balance it was at when you got your EIDL loan. There's talk that if you don't use the money for just COVID crisis costs, that you could be in default. A lot of people took and just paid down other debt with these. And I think that's probably a case where you could be found to be in default. It can't be used for the same expenses you use for your PPP loan, but you've got to use it for COVID costs, and you're required to keep documentation again of the specific items you paid for with this loan. There's a requirement, or you kind of agree to the extent feasible, purchase only American-made equipment products. Where could the government go with something like that? There's a requirement that you cannot take distributions, and it does not accept taxes for that. So a lot of people, as they make money, they take distributions and pay taxes. Well, if you have an EIDL loan, I think there's potentially some problem. And there's also some language that looks to limit bonuses that may be paid to owners or shareholders of the business. So a lot of stuff there, and there are some penalty clauses that basically says that if it doesn't like the expenses used for the EIDL loan, that you could have several penalties equal 150% of the loan amount. So a lot of things are kind of gotchas there, and I would just caution people, if they have these, to look back and see if they want to keep the loan or they want to repay it and make sure they're complying with it. And if they don't have it or are looking at getting one, at least look at these items much closer. Want to run through this. This is deferral of employee payroll taxes. This came out from an executive order that President Trump signed that basically allowed employees from September 1st of 2020 to December 31st to not pay their share of FICA, not Medicare, but just FICA tax. So it'd be 6.2%. And then basically said an employee could make this election, and then what they would do is pay this unpaid amount back somewhere between January 1st and April 31st of 2021. Again, to give a short-term cash benefit to employees to help them see through this pandemic. The problem was there's a lot of stuff unanswered. And the first is, let's assume that an employee makes this election and then doesn't pay this FICA and then terminates with the employer. Well, who is responsible to pay back that FICA next year? Is it the employer or the employee? And we don't know, and there's no guidance. The one thing good that did come out with this guidance is that it said this is really an option up to the employer to allow for his employees. And so what I would basically tell you is that most employers have opted not to provide this to their employees. First of all, there's risk to the employer to have to pay back this unpaid FICA for employees that are terminated or quit. Secondly is, think about, a lot of our employees. They'll get this tax benefit, and that's a windfall, and they'll enjoy it. But think about next January when it comes along and you've got to pay twice the amount of FICA. There's going to be a lot of employees surprised and not realizing what effect that's going to have on their paycheck. So I just think overall, it's probably not a great program. People can look at it, but look at it closely, if you're going to do it. Lastly, we want to basically just talk about what looks like future COVID assistance. This has been bounced around in the news and Congress back and forth. It has not passed. We do see that there's likely going to be at some point some more assistance come. And I just thought that we'd go through a few of those items just for people as they're thinking with this on how it may affect their dealership and how they want to plan their marketing and car purchasing and that kind of stuff. The first thing is that we're likely to see more stimulus payments made to people like we did in the first round. And this will be somewhere between $600 to $1,200 per individual. And it would be twice that amount for married filing joint people. So it'd be probably $1,200, $2,400 for married filing joint couples. There will also likely be some additional money for dependents of $300 to $600 per dependent. So basically, we'll see that there's likely going to be some more money coming to the public's hand. We found dealers were very efficient in trying to use this to help customers either acquire cars or get caught up on loan payments and things of that nature. So it is likely we're going to see some more of that. There will probably again be a phase out based on a taxpayer's individual income. So some people may not get the stimulus if they have too high of income. The next thing I think is very likely to happen, and that's some sort of tax credit for PPE cost that people incurred to comply with, some of the COVID restrictions. And this could be masks, this could be plexiglass, things of that nature. We likely expect a tax credit, which is a dollar for dollar offset for 30 to 50% of those costs. We don't know if there'll be a limit, but it is likely we're going to get that. Remember, at this point, we don't think those costs count for PPP forgiveness. So, and then lastly is we do expect another round of PPP loan and forgiveness. This will likely be more limited than it was last time. This will likely be provided to just those employers that have 300 or maybe less employees. So it'll be smaller businesses than the last round. And it's likely going to require some sort of gross receipt test so that, you've got to look at maybe the first 6 months business this year and show that your gross receipts from prior years were down 25 to 50%. Well, for a lot of dealers, we found that surprisingly, this didn't occur. So with these 2 additional requirements, we would expect that probably half or less of dealers that may have gotten PPP loans and forgiveness in the past will get this future round. Only time will tell, but we do think it'll be a lot less of us will get that. So I wouldn't quite bank on that unless you feel like you fall in one of those categories. I don't know if you've got any other thoughts, Lee, but that wraps up today's information we've got. Any final thoughts you've got, Lee?
No, I think it's just important that you have somebody who's familiar with the process, review your PPP application, and make sure it's done and it's submitted right. I've seen a lot of issues with the application process, so I think it would be best to just make sure you got somebody plugged in who knows what they're doing. So.
Yeah, thanks. That's a good point. I know we're helping a lot of our clients with that, and I do think, remember, this is public information and it is government information. So just, be smart in how you proceed and what you do and follow the guidance. Absolutely. With that, thank you to everyone, and we look forward to any questions, and feel free to always reach out to Lee or I with any questions.
Thank you.
Thank you, Lee. Thank you, David. And to everyone in attendance today, that's all the time that we have for today. We will compile any unanswered questions submitted, and the presenters will respond directly. Once you leave today's session, you will receive a survey on the presentation. We appreciate your time in providing us with valuable feedback. To attend another breakout session, please return to the convention agenda and select the link to log into the next session. On-demand content is available at your convenience in the on-demand section of the convention website. On behalf of NIADA and our presenters, thank you for joining us today, and have a great rest of your day.